Good day, everyone, and welcome to our Pellegrini Financial third quarter market update. Um, 2022 seems to be slipping by again very quickly here through this year, and not sure where the time goes. Maybe it's an age thing, I'm not sure. Um, this year generally has been kind of uneventful, actually, for in many respects. I think some of the things economically that's been new or that had to be dealt with is the supply chain disruptions that are more en masse and prolonged than expected. And I think from an employment standpoint, there's been a lot of changes or employment gaps, I suppose, where again disruptions to um, the employee who wants to be employed more than anything, I guess. And we'll come back to that here in a bit. When we look at the markets, again, really not much volatility through the year, generally speaking. Markets have been pretty steady from early on in the year all the way through until recent. And that in the third quarter has been the same result, I suppose, where July and August were both good positive months, and only in September have we seen a bit of a pullback. Not really a correction per se, but certainly a bit of a pullback and some gains pulled off the table in that quarter. Still positive for that quarter, but muted in comparison to other periods of the year. And when we look at more of the sectors or the components of the markets, North America in general was a positive quarter in Q3 here, and European markets were slightly negative, I suppose, and in China or Asia was more of the negativity, and again, coming out of China in particular, as some of the real estate bubbles there started to burst. When we look at sectors, um, basically through the Canadian markets, we had industrials that performed relatively well in Q3. Consumer discretionary as a whole through the year, energy has still been a big boost to Canadian market performance, including financials, especially early on in the year. And then, of course, information technology has been another good performer in Canada. When we look at the commodities, and we'll circle back to energy here, we've kind of bypassed that over the last few rounds, but um, oil in particular, of course, has been phenomenal through the year, much beyond expectations for most economists. Where 60, 70 at best was expected, where we passed through 80, kind of come back down as of late, but either way, oil has been outperforming well beyond what the expectations were, which is obviously good for the bottom lines of our energy sector. Western Canadian Select still trading at a pretty big discount, but not as bad as previously. And as pipelines come on, hopefully that negates some of that discount. When we look at the natural gas has performed very well, which was maybe more in line with some expectations, and energy demand continuing to grow. I think natural gas still bodes well. When we look at interest rates, this is a 25-year chart of the 10-year U.S. bonds, and obviously it's been a steady decline for 25 years. We've had a couple of bottomings here that we just broke through, of course, in this past year, and have come back up to, and that's what the green marks there are on the slides. Um, and the 10-year bond, it kind of sets the basis for much of the economy. And I think whether that's a bottoming or not, time will tell. Um, Obviously, from an investment perspective, government bonds have basically been underweighted, high yields have been overweighted, and most bond positionings or fixed income has been short on duration, which is what you kind of want or expect in a declining interest rate environment. This is still a 10-year US bond note graph. It's just shortened down into this last 12-month period. And I kind of put this in here just to explain more, as I've wanted to the last couple of times here, how bond pricing gets influenced by rate changes. And I'm going to pause the slides here for a moment. Um, and really what happens is, and we saw this early in the year, so we saw a big increase in the 10-year bond note that impacted fixed income components in our portfolios in that first quarter. Of course, we've gone through a little bit of a swoon here in the middle part of the year, and then we've seen a bit of a rise again as of late. But as interest rates or bond yields rise, prices fall. And as interest rates or bond yields fall, prices rise. And so, what do I mean by that? Well, as an example, if I bought a Government of Alberta bond last year at 3%, 10-year bond, doesn't really matter what the length is, and This year, of course, we're still borrowing money, and the government of Alberta is issuing new bonds again. But now interest rates have risen, and now they offer that at 3.5%. So for me, who holds that 3% bond I bought last year, if I wanted to sell it, well, who would really want to buy it, right? Anyone wanting to buy bonds today would go to the current market and get 3.5%. So for the only way for me to get rid of my 3% bond is to essentially discount it, right? Reduce the bond price. So if I put $10,000 into that bond and I want to get rid of it, well, I got to discount it, let's say to $9,500, right? So I reduced the price of that bond. And so because those interest rates and yields rose, the bond I currently hold, I've had to discount, right? And the price falls. So, and of course, the inverse happens. So, if interest rates were to continue dropping, and went down to 2.5%, and I hold a 3% bond, if I want to sell it now, I can sell it at a premium, right? I can sell it for say 10,500 in the market instead of the 10,000 I paid for it. So that is the relationship between um, interest rates and bond pricing. And I know that's just a bit of a short explainer. Obviously, there's lots of other things that impact um, bond pricing in the fixed income markets, but that's just one little component that has a big impact in how we actually saw that in the first quarter of this year. So, like I said, shorter duration bond positions certainly negate some of that. Like I said, there's other things that factor into that as well, which um, are part of fixed income investing. When it comes to inflation now, inflation, of course, has been rising over the last number of months. Obviously, in this past quarter now, we've breached through the 4% inflation rate level. Again, there's still two camps of transitory or structural. Transitory, where like supply disruption, vehicle chips. I note there as an example of vehicle price increases, especially in the resale market, because there's less production of new vehicles because there's a shortage of chips right now, which will pass. Of course, there's other inflation like food prices, and part of that maybe comes into energy as well, where those energy costs translate down to everything. And the concern there is that's permanent, more structural. I don't think there's a clear answer for which way that goes, but that's certainly where you still have two camps. When we look at currencies, we see the Canadian dollar through the third quarter here was basically depreciating against the American dollar. Obviously, in this first month of quarter four now, it's jumped in valuation, which is a good thing for snowbirds that are heading south. Obviously, I think a strong energy market also is going to support the Canadian dollar going forward. I just note a little bit of cryptocurrency here, and the bitcoins of the world have certainly seen a jump in price, but those have become more commoditized. So the retail investor now can really invest in cryptocurrencies without actually owning the cryptocurrency. More than anything, it's becoming a lot more regulated. So from the standpoint of here to stay, the more it's regulated, the more it's likely to stick around. So as we wrap up this third quarter market call, I think the things to look forward to. I mean, obviously, what's going to impact markets is the amount of tapering or the amount of fiscal stimulus that is being pulled back out of the system now by these central banks. Also, government policies. A lot of the support programs that have fallen off the table have not been renewed. Some still have, but again, those are expected to pull off. How does that impact markets, the economy in general? Markets right now certainly are fairly priced and then some for the most part. Really, what comes down to is that consumers still want to spend, and government and certainly corporations make money from that. Um, I think it's at this point now more selective of asset allocation, maybe security selection, of course, as well, and just a continuation of seeing what kind of impacts these stimulus programs and government programs, how fast they are retracted. So once again, thank you for joining us here in this third quarter call. If you have any questions, obviously give us a call at the office at any time, and we appreciate you joining us. Take care and bye for now.